Nick Paulson, country head with Espirito Santo Securities, joins us live from a Mumbai studio. Nick, morning. Thank you for joining us. A bit surprised with the print on the ticker. It's back above 5,900 on the Nifty. What is driving markets? Hopes of recovery or global liquidity?
I think not hopes of recovery. I mean, if you look at it, India's been trading in a broad range for the last year, and I think that's going to continue. I think now I think the market's handled the US shutdown reasonably well. And I think most people are now just waiting for earnings season. But my sense is you're going to get a difficult earnings season, extremely choppy, huge variability between sectors in terms of performance, with some things like IT doing very well, but other sectors struggling because of all the volatility in the quarter around currency, etc. So I think difficult earnings season and further GDP downgrades. So I think there's some downside for it from here before you get any kind of sustainable rally.
So do you think we may top around the 5,900 mark, or is there a chance that we may scale out a little bit further and post the earnings start trickling in, we may ease out all the way back to, the 5,000 mark?
Yeah, I think you could have, especially in the beginning of earnings season, because it's mostly the exporters, particularly the tech firms, that report early in earnings season. And I think generally you're going to see very good growth, both in terms of the rupee effect, but also they've got the end markets very clearly improving in the US and EU. So I think that could be a good early earnings season, people thinking maybe there's a turn, and then you see later in earnings season more weakness. So perhaps you could see further short-term upside, but then I think the market will struggle.
Are you surprised with strength in IT? Rupee is not at 69, it is at sub 62. US economy, we know the federal government has shut down, which means US economy for this quarter, the GDP growth could be an issue. So IT should be a sell, not a buy, but IT stocks are still holding on.
Yeah, but the rupee's ultimately, yes, it's come off the sort of 68 levels, but for the quarter itself, you're going to see, in terms of the overall cross-currency effect, it's clearly a major tailwind, and it's combined with, ultimately, good underlying demand conditions. Discretionary spending is improving, I think, quite materially in the main end markets of the IT services firms. And also, they're relatively well valued compared to the other hiding places of consumer and pharma, where you're looking at the stocks are mostly sort of 16, 17 times rather than 30 odd times for FMCG and 22, 23 times for pharma stocks.
Nick, we had delivery volumes of about 82% in Infosys yesterday. TCS as well was big. Do you think it's going to be another stupendous quarter from Infi, as was the case the last time?
Yes, we do. We think Infi, I mean, we're well above consensus in terms of our forecasts, and we're expecting a very good quarter. And I think expectations have been catching up with Infosys, but there's still mixed views on the street because of changes in terms of senior management changes. And I think you've got a number of things at play, Infosys, both the end market conditions, the currency, but also signs of internal improvements, better confidence within management, better in terms of the internal collaboration between the delivery side and the sales side is improving. So I think there are a number of levers there which make us confident you're going to see a good quarter and probably a sustained period of improvement for Infosys, not just a quarterly improvement.
What explains the strength in September auto dispatch numbers? Company genuine demand or push ahead of festival season?
I think it's a mixed bag. I think you saw some numbers that are quite good. So I think Bajaj Auto's numbers were good, and I think there's some firm specific factors as well as some festivals elements to it. I think two-wheelers are better than four-wheelers at the moment, so our pick in that sector is Bajaj Auto. We think that it looks good value. It's now 35% of the business is exports, where we see actually better growth in the export business than locally, and it's less vulnerable to Honda competition than Hero. And then within autos, we prefer auto components, so Motherson Sumi, beneficiary of our weakness because of its European business. Very well-run firm, and that's going to continue doing well.
What explains the strength in the entire metals basket, Nick?
Well, finally, people have decided that metals is investable. So we've had our poor metals analyst has been trying to persuade investors to listen to him about metals for some time. It's just not been deemed an investable sector. So most foreign institutional investors haven't touched it, mainly because of perceptions of regulatory uncertainty and regulatory risk. And I think people are beginning to see signs of some stability, possibilities of things like the iron ore ban being eased. And then you've got firm-specific factors like some of the firms, it looks like they're going to have a good quarter. So I think a lot of people are looking at it. And also, if you look at the aggregate numbers for metals last quarter, they're actually pretty good. And I think it's going to have a good quarter this time as well. So a number of things, firm-specific as well as people just re-looking at the sector.
Nick, so what's your house view in terms of what the central bank may choose to do again this month? And do you think again it's going to be a hawkish move and another hike in interest rates, and that indeed is not going to go down well with the market?
Well, it wouldn't go down well, and it was already a big surprise. I mean, that is not our base expectation. But then it wasn't, nor was the expectation last time. So I think we face, the central bank's priorities are very clear, and they're not the priorities of the market. The market wants the central bank to focus more on growth. The central bank is very focused on its inflation targeting. So I think, and so you have this issue of very tight liquidity conditions. So in terms of overall corporate liquidity, and then you've got a combination of corporate balance sheets are quite stressed because of a number of issues. And so that combination of tight liquidity, stretched corporate balance sheets just mean that that's a big headwind, I think, in terms of earnings.
So what's the expectation this policy then?
I think I'd be surprised if there's a repo move this one.
I think the fact that earnings will be bad, there are NPA concerns, Indian economy is not recovering and may not recover in the foreseeable future is all old news. How does one figure out that what is the quantum of degree of bad news which is in the price? Because markets, they always tend to discount events well ahead of the actual occurrence.
Yeah, I think you're right. If you think about the last 4 quarters, you probably have brokerage houses coming out saying the worst is behind us, that we're going to see a turn in the earnings cycle. And then it hasn't happened, and everybody's given up. So expectations for earnings are weak this quarter. But in my experience, when you're still in a downgrade cycle, when bad numbers come through, it's really difficult for share prices to perform in the face of the reality of weak numbers. So I think, yes, quite a lot is priced in, but I still think you're going to find sectors that I think within the banking system, given all that happened in the last quarter, you're going to find surprises going on there. I think industrials will continue to be very weak and surprise people. I think consumer staples, look at what happened when Unilever warned on its numbers. That was the first warning Unilever's done since 2009, focused on emerging markets. I think you could see some weakness in consumer staples, which until now have actually held up remarkably well. Consumer discretionary likewise. How do those sectors perform in the face of bad numbers coming through?
So what happens with all this weakness that you're talking about? Because the market clearly has lots to look forward to this month itself. Do you think we'll manage to defend the last time low of 5100, 5150, or is there a chance we could drift down further?
No, I think that low has been defended several times now. I think you are stuck in a range, and I think and most people seem to be trading that range. And to break out of it, I think you need clarity in terms of where we go with elections, combined with confidence in the underlying numbers in terms of growth. The recovery in growth is the key thing for a sustainable rally, both in terms of GDP and earnings. And I think people will wait for the numbers. They're not going to run ahead, because people have run ahead before where they've anticipated an improvement in the capex cycle in GDP growth, and they've been caught out. And I think that's why you're going to see the market topping out within the trading range we've seen over the last year.
So since we are in a trading range, the best strategy, I guess, for even investors is that you trade in and out when you reach the upper and the lower end of the range. We are now nearing the upper end of the range. So what are you advising your clients? What should they sell? And on decline, what should they buy if we go to 5,500?
Yes, I think some of the stocks that I'd sell into this quarter will be around those sectors where I expect weakness. So stocks like Hindustan Unilever.
Okay.
I know it's already come off a lot, but it's still very, very expensive. It's still trading at 35 times earnings. You've got, I think, it had a great run for 6 months, given the open offer and expectations of Unilever raising the open offer. You've got poor volume conditions for volumes, hikes in terms of advertising and promotion, which is going to hurt margins. They've had a royalty rate hikes. I think a lot of pressure on that as a stock. And I think generally that's an example within that sector. I think you could see some weakness, especially those that aren't. The most robust ones will be the ones with most rural exposure, but otherwise I think weakness in consumer discretionary and consumer staples. And I think you'll see some of the stocks like BHEL, which have recovered on hope. When you see the reality of numbers, I think you can see weakness in those sort of stocks again.
Let me phrase my next question rather carefully. Give me one stock which you are happy to own for next 3 years. Give me one stock which you would like to buy for a 30% pop, and give me one stock which is more like a flip of a coin. If it works, it's going to be a multi-bagger.
Yeah, so I think in terms of multi-year buys, I think within the banking sector, I'd say HDFC Bank, expensive, but I just think it's got such strong competitive advantages. It's the best clearly the best bank in the sector, and I think will remain so. I'm confident for 3 years. You can put it in your drawer and it'll do well. I think for a pot, Hindustan Zinc for the next quarter. I think for a punt is a stock which we've consistently been getting wrong, but I think Max, so an insurance, majorly exposed to insurance, as well as it's got the other subsidiaries in healthcare. I think that's a stock where there's very considerable upside, although it's had a difficult year to date.
Max represents the insurance sector. The insurance sector is in a spot of a bother. Why would you like to go close to a sector which is not growing?
The insurance sector, you're right, has been in a spot of bother for some time because of regulatory changes from IRDA, and there was a lot of concern around product, because there will be changes in product rules which come up in October, although the deadline's been extended, which I think will be beneficial. But I think ultimately sometimes you wanted a stock which is a multi-bagger. I think this is a contrarian one. Insurance is not well understood, and I think this has been harshly punished, and I think it's actually, if you look at its product suite, it's the least exposed to the regulatory changes from IRDA. So I think it's a much better business than people give it credit for, but you need to hold it for some time. I would not buy this on a quarterly view. I'd buy this on the basis if you want to hold a stock which over a 2 to 3 year period could double or triple, then that's the kind of stock, and you need to have a reasonable risk appetite.
Nick, really good chatting with you. It always is. Thanks for waiting by in our studios and speaking with us this morning.